Good morning, Jags. This is Fahad. Today is Thursday, March 18th. Let's get started. While the equity market futures are starting to look down again, once again led by NASDAQ, which is down more than 215 points right now, down 1.6%. S&P down 26 points. Dow is almost flat. I wanted to take a look at whether there will be some interesting opportunities on this weakness today. And one of the stocks I'm looking at is Anheuser-Busch, BUD. Now, this is one chart that's in front of you, and then same chart is also over here. So let's keep this technical picture in our mind. If you look closely, you will see that it broke out through a downtrending resistance yesterday on rather decent volume. I wouldn't say this is high, but it is improving. MACD is powering higher. RSI is starting to climb and has reclaimed 50 levels. So there is definitely relative strength over here. It still needs to show that it can come up, that it can blow through all of this VOP congestion level that you see around 63, 64, 65 level. But once it can clear all through 65, then I think then the path of recovery in this stock will be much easier, and I could see this thing go to 70 plus, maybe even 75, and go to a new 52-week high. So this is the technical picture. Now, there's a very long, detailed bullish note out from Morgan Stanley a couple of weeks ago that I've been saving, and it makes the case that the emergence of the U.S. hard seltzer category, which appeared in 2019, has been the most important new trend in the U.S. alcoholic beverages industry over the last 3 decades. Basically, if you want to compare the innovation of the hard seltzer category, there has never been more profound change in the beer industry since going back to when the light beer was introduced the first time back in the 1970s and the 80s. And the category, this hard seltzer, is growing at 200% CAGR for the last 2 years, despite the pandemic. And it is reaching retail sales now of $4.5 billion annually already. So it has been a very, very significant change for the beer industry. And it has attracted a whole bunch of new competition because everybody's starting to realize that they need their presence in this. According to the deep dive analysis, they show that the growth category still has a longer runaway than market perceives currently. In fact, they believe that the CAGR will remain 35% all the way through 2025, and it will eventually reach the total market share of the U.S. beer industry at 19% even then, which means that at such a strong CAGR of 35%, we would have only reached 1/5 of the beer market in 5 years from now. And arguably, this CAGR is likely underestimated because, like I said, even during the pandemic in the last 2 years, it has been over 200%. So the conclusions based on so many models and the changes that's in front of us, benchmarking analysis and the growth beverage category and all that, after 3 decades, basically supports an argument that there's going to be not one, but there's going to be multiple winners in this industry. It is also it's attracting the trendy, the young, the youth, and you probably have seen yourself in the families everywhere. A lot of people are drinking hard seltzer than anything else. And so, the market is currently concerned about the potential ultra fragmentation of the category, meaning that, there's a few brands only, which is White Claw and Truly, that are currently have 75% market share because they were the first one that were the innovators in the industry, but they're all going to lose market share and it's going to get dispersed across many different producers, resulting in the benefit of all of them. Now, why am I bringing all of this up? I'm bringing this up because Anheuser-Busch, according to their own press release that came out not too long ago, right over here, this was on March 15th, they launched their first ever, they call that Cacti Agave Spiked Seltzer. And this is what the picture looks like. Or actually, there was a picture over here. I'll bring it up shortly. But this was launched on March 15th. And according to this press release, This was originally announced in December, and the Cacti Agave Spike Seltzer is the future of the seltzer category, they call it. The 7% ABV seltzer made with 100% premium blue agave from Mexico will be available in 3 flavors at launch: pineapple, strawberry, and lime. And that day on March 15, when this press release came out, Scott, which is the CEO of the firm, also introduced fans to the world of cacti for the first time with a new TV commercial, which they're now running across everywhere. And that commercial was also debuted during the 2021 Grammy Awards to get as much traction as possible right out of the gate. And so, based on this press release, and this came out on March 15, now, yesterday, CNBC is reporting, and here is the picture of what Cacti looks like. CNBC is reporting based on an interview with the CEO, Travis Scott, how this category is doing. And this was covered in today's first read as well. I will read a quote over here from the CEO. They said, physical retailers are reporting strong sales. Several of them are saying that they have never seen anything like this before. Sold out within 1 day, end quote. Let me repeat that again. This is the quote from the CEO. Physical retailers are reporting strong sales too. Several of them are saying they have never seen anything like this before. Sold out within 1 day too. So this, this is a pretty strong statement only 2 weeks after the launch, not even 2 weeks, less than 1 week, sorry, after the launch. And the stock responded to that rather very positively yesterday. And considering this is down about 10% from its 52-week high, if this market stabilizes and we start to see some traction, this is a brand new product cycle in play in a category that is growing extremely strong. And then consider the fact that Anheuser-Busch, the breadth, the depth of this company, they own the Budweiser brand naturally, among many other brands. And so they have the distribution network globally in every place possible. So for them, unlike some of the other smaller players that are entering into hard seltzer category, they're going to have very, very easy time expanding the reach of this cactus or cacti hard seltzer brand globally very, very quickly. And I'm looking at the earnings models and the expectations that came out. And I can tell you that the consensus has a lukewarm reaction so far. And this is where the element of surprise could come from. So, for example, last time when they reported earnings on March 21st, this is Bank of America note, they reduced their EPS guidance by 6 to 7% after March 1st. They did acknowledge that just like all the other quarters in the previously, the top line growth continues to be strong. The revenue growth was 4.5% year over year, which was well ahead of the beverages peers. But because the EBITDA margin is coming down, it was quite disappointing, and it is not similar compared to the other quarters, and so on and so on. They actually cut their EPS estimates. So it tells you that on the street, the estimates are coming down, at least on the EBITDA and the earning sides, even though the top line revenues was pretty strong. And those top line revenues should only accelerate based on these comments from the CEO. Meanwhile, the CEO is telling us that they're sold out and they have this, they're going to push this brand into every single market very, very quickly. So with all that said, I think there's a technical setup here as well as the fundamental setup to surprise to the upside. I like this chart. I think this thing is going to gradually climb higher in the next couple of months, reaching all the way back to new 52-week high. And maybe this is going towards $100 per share. We'll see. That's it from me. Let's go to Jay.
Morning, everyone. So I have 3 stocks to talk about, and I'll try to be brief with them. Stock number 1 is Intellicheck, ticker IDN. This was a Q1 top pick that has unfortunately faded over the last month. Clients were asking about the company's most recent earnings report, and what I can tell you is that revenue was up 6% year over year, 14% sequentially. Its SaaS revenue was up 18% year over year and 23% sequentially. But the overall revenue number of 3.1 million was below what analysts were expecting. HC Wainwright, for example, they were expecting 3.3 million. And, a lot of this is due to COVID closures, on the retail front. For those that don't know, essentially, their software is used when a customer goes up to a register in a brick and mortar location to apply for a new store credit card. And IntelliCheck software then essentially authenticates, validates that customer. And the company talked about how same brand transaction volumes were down on average 20%, with many regions of the country still not open or limiting their traffic. So that was unfortunately a headwind for them. Now, on the flip side, management did talk about there were 10 new customer implementations in the quarter. They also signed a California-based company that does tenant screening for rental leases, and essentially it opens up a new vertical for the company. So it's not just brick and mortar retail focused. HC Wainwright was out with a post-earnings note. They expect the company to complete between 30 and 40 software implementations during 2021. So overall, in terms of a ranking system, if I had to give you one, between the write-ups that I've done for Q1, Durham Tech would be at the top of the list still. KRNT Digital, which I'm going to get to in a second, that would be on the top. But IntelliCheck, that's probably going to be a 3 or a 4 for me. Look, you're just going to have to wait until the next quarter to see if these COVID headwinds have gone away. And that's really all I have about that one right now.
The top line growth was disappointing. I saw the earnings release last night too and came below expectations. And I did expect some pressure on the stock, although I did not think that this would come down more than 10% yesterday. But this is also a function of the market where they're simply not rewarding stocks that are reporting dismal quarters. So my view on this one is that I think it's time to just simply step aside from this one, because I could still see this thing come down to that important support just below $8 per share where the major VOP lines are. And chances are that it's going to be about another quarter, maybe even 2 quarters before this will make a U-turn and then show some resilience when everything is open back up. So this is probably a lost cause at this point for some time in the short term, at least in my view. All right, next one.
Stock number 2 is KRNT Digital. So yesterday, the company announced that.
Sorry, what's the ticker?
KRNT.
Yes.
KRNT announced that leading on-demand printing and fulfillment center called Printful would be adding more than 50 KRNT Atlas systems during 2021. Essentially, this announcement is part of that company's production expansion plans across LA, Dallas, Charlotte, Mexico, Spain, and Canada. Stifel was out with a note saying, "We believe the acceptance of these 50 Atlas systems is upside from its prior order and likely provide some upside to 2021 estimates." They also believe the sizable order reflects the shifting industry trends and the need for KRNT systems to meet the demand outlook. So between new orders coming in, you still have Amazon as a top customer, and they're going to deploy new money into KRNT systems. This is one that I still like for the future.
This company just keeps getting new orders over and over again. It just seems like every 1 or 2 weeks or 3 weeks, they just get another press release. Oh, we got more orders. We got more orders. And Amazon remains the top one that just keeps spending money on the platform. So I continue to love this story. And it has pulled back with the technical sell-off. But aside from that, there really hasn't been any reason. All the Jack clients know, because many of them were positioned going into this earnings in the middle of February. And even as the market was selling off, this thing had a massive spike on very high volume. So the stock has served well a lot of Jack clients. I'm sure many took profits on that gap higher as well. We continue to like the name in the long run.
Yep. And then finally, Las Vegas Sands. You've talked about the company this week many times, essentially Macau, Londoner, that opening. But I also want to quickly point out that recently the New York Senate passed a bill that would bring mobile sports wagering to the state, along with more land-based casinos. 3 downstate casinos would be allowed, with 1 being in New York City or Manhattan. 2 of the 3 licenses are expected to go straight to gaming properties that have already been okayed to run slot machines in the area. So that includes Resorts World Aqueduct in Queens and the MGM-owned Empire City Casino in Yonkers. However, in a recent New York Post article, Las Vegas Sands is in a position to win that final license. And according to a report from City Limits, the budget bill directs the State Gaming Commission to issue a request for applications for casino licenses by July 1st and decide on winners within 150 days. So this is just another potential catalyst for the company.
Nice, light, nice, possibly not as big, but maybe a little catalyst, but it's definitely incremental. 3 properties. So one is Las Vegas, second MGM. What is the third one? I think it was the first one you mentioned, but
Yeah, it's called the Resorts World Aqueduct in Queens. I don't know who owns that
who
though.
owns it? Okay, all right. So LVS and MGM would be play on that. Slightly incrementally positive news on LVS. There's a lot of other moving parts that benefit LVS too. So good stuff. All right, fantastic. All right, let's go to Chronicle.
Morning. Looks like we're doing a bit of a top pick medley today. I have an update on JR West, which is another one of our top picks this quarter. Ticker is either WJRYY or 9021 Tokyo. And this update is to do with the latest news that Japan is ready to lift its state of emergency in Tokyo this Sunday, as well as for the 3 surrounding prefectures that were also affected. And that's despite a recent uptick in new cases. Now, one may think that this is more of a positive for JR East, whose network covers Greater Tokyo, but I believe this should also be a benefit to JR West, especially if the government decides to reinstate and extend their Go to Travel subsidy campaign, which was one of the main pillars of our bull case presented in the Q1 quarterly outlook. From the leisure and hospitality industry's perspective, that campaign was a success before it got suspended, with restaurants, hotels from the Kansai region indicating almost pre-COVID levels of business from domestic travelers, excluding inbound. And with the states of emergency now being lifted, I think popular destinations that fall under the JR West network, such as Osaka and Kyoto, they're probably going to start seeing more travelers from Tokyo. So first of all, looking at the latest checks from the company, we can see from these tables that their total handling revenue has now turned positive to 3.3% year over year, compared to negative 78% during the pandemic trough. Similarly, the company's recorded passenger volume is now down only mid-teens to low 20s versus roughly negative 90% right around last year. And then separately, looking at the latest Economy Watchers survey outlook, responses from hotels, restaurants, store owners, department stores within the Kansai region, where I've isolated the most important bits of commentary. And it would seem that the vast majority of these respondents are now optimistic about future incoming business. However, I would stress that there is the caveat that a lot of this optimism is going to hinge on whether or not the travel subsidy that I talked about actually gets reintroduced and possibly extended. So that's going to be the key catalyst to watch. And we mustn't forget that JR West also operates hotels and retail properties in prime locations, which together make up 20+% of their revenue, which is why this Go to Travel program is extremely important for them. Now, in terms of where I think the stock can go, over time, I would expect it to get back to near pre-COVID levels at around 8,000 yen over the next 12 months, so roughly $70+, give or take. I don't think it's going to recover all the way back to 9,000 yen anytime soon, because we have to keep in mind this company is coming out of the pandemic with a worse balance sheet and likely no share buybacks, and also the incoming tourism from foreign travelers is going to be more of a 2022 story rather than this year. And on top of that, the upcoming Tokyo Olympics is not going to allow foreign spectators. So the lack of international tourism is still going to be a headwind this year. There's no question. So overall, this has been a very nice run in the stock. It was one of those where the stock was trading so depressed that you just knew things were going to get better, and everybody knew that the pandemic wasn't going to be around forever, and yet the stock was trading like it was end of the world when we were buying it.
Yeah, and this is exactly how, one can see this case, the bull case for West Japan Railway, and can easily see how it's a classic case of how Jaguar Analytics tries to differentiate itself from so many of the masses, where looking at things that may not be on anyone's radar. This top pick from the Jaguar first quarter outlook right here, many Jag clients are already long this, from $49.50 when it was recommended in the first quarter outlook. It's up now 24% year to date. Meanwhile, the S&P is up only 5%. So this is significant outperformance compared to the S&P. Purely technically speaking, if you look at the daily scale, this is actually has been consolidating in a not quite a bull flag, but I would just say a range consolidation for about 6 weeks now. VOP bars have started to thicken over here. And basically, this is still a setup for more upside to come, in my view. And then if you zoom out to the weekly scale, I think that once this thing starts to break out through 62 to 63, the next leg higher should carry the stock all the way to about $70 per share. That would be another 15% to the upside from current levels. And that will put it pretty much squarely back to near, not before pre-pandemic, but near the pre-pandemic highs. And I think the stock needs to go there. It will go there, given that we continue to open the economy gradually, as Chronicle just discussed. Once again, this is not the type of name or not the type of research that you will find in other places, and that's where the differentiation factor comes into play. I like it. Really good update on this one, Chronicle, and well done for making this a topic in the Jaguar first quarter outlook. All right, folks, we're going to stop over here. Thank you very much for joining. We'll see you in the chat room shortly.